So that's what's going on with gold. So it appears to me as if people are going short gold, a little bit short silver, but really short gold. Why? Because gold and silver spiked so much. Gold approached its all-time high. As it started getting close to its all-time high around 2000 and higher last week, that caught data, the bullion banks come in and just, hammered it and shorted it. And hi, everyone. This is Rob Kientz with GoldSilverPros.com. I'm recording this about 1:32 p.m. Central Time on April 14th, 2023. This is your weekly market wrap-up. Title of today's presentation is Deflation Strikes the Economy. Let's get into the data without further ado. Gold has been doing very well this week. It hit about 2040, about $30 off its all-time high. Right now, at time of this broadcast, it's trading at $2,004.13. It's basically been smashed down about 35.70, and I'll show you why that's happening because we have the COT report where I'm going to show you which traders are doing it. Silver's trading down 45 cents, or most likely doing it, I should say. Silver's trading down 45 cents to 25.35. Silver's taken a lesser hit. Well, it's about the same hit percentage-wise, about 1.75, 1.76% down each, but looks overall less worrisome on silver. But definitely, the market, gold and silver had gotten frothy, and the market thought it was time, for those prices to come down, which does make sense. We always have healthy pullbacks in most markets after a healthy bull run, and we definitely had that in gold and silver. Looking at the economic data, the story is that wholesale inventories are up, and the inflation, though, is down. So wholesale inflation is down. The PPI numbers, the producer price index, what wholesalers look like before we get, the products to the store where the retail buys it, is that inflation drops, and that's deflation. In other words, prices are dropping. We have deflation in those because we have too much stuff. And if you remember back the last couple of 3 episodes, I've been talking about inflation, deflation cycles, and how we're talking about inventory stuffing. There's too much inventory in the system. And so now those prices have to come down to clear out that inventory. And that's why wholesale prices are actually in deflation. And that's where we're going to see lower prices. And I'm going to talk to you in a moment about what parts of the CPI or the consumer price index are actually falling. Also, a note from U.S. small business confidence edged down in March as expectation trim. As I'm looking at the Market Watch article by Xavier Fontagloria, he says confidence among U.S. small business owners deteriorated in March as uncertainty from the banking turmoil led to a pessimistic view of business conditions and sales prospects in the short term. The National Federation of Independent Businesses said Tuesday that its small business optimism index decreased to 90.1 in March from 90.9 in February, well below the index long-term average, and erasing the slight gains in confidence registered the first 2 months of the year. So it looks like small business is starting to turn down because the sales are turning down. Sales have been down. Overall, producer price index is down. Sales are down. Inflation is down. U.S. retail sales down another full percent this month. Last month, they were only down 0.2%. Prices are falling. Minus autos, it's only 0.8%, which means autos are falling slightly faster than the rest of consumer prices. And because it's such a big ticket item, we look at that separately, much like we do real estate, and call that out. Import price index is also coming down. So we have a little bit of worldwide deflation, and the import price minus fuel is also coming down. So regardless if you're including energy, import prices are coming down, which means everybody else's prices of stuff that we buy to come over is also coming down. So the deflation is not just happening here, it's happening everywhere. Good news on the economy and capacity utilization, it's up slightly, which means because we have a little bit of deflation, any capacity utilization that's up is positive. It means that we're not hitting runaway deflation. We just have deflationary forces. As long as that utilization in the economy stays up a little bit, it means we're still producing. I don't expect a big crash. Consumer sentiment is up just a little bit. The CPI, the big number, is down. The consumer price index, the government's measure of inflation, not mine, but theirs, is down to 5%. It fell a full percent since last month, where it was at 6% year over year, meaning from March of this year to March of last year, prices went up 5%. From February of last year to February this year, they went up 6%. So that means prices are, we still have inflation, but deflation is slowing down. We're still 5% higher prices this time than over last year, but it's slowing down because month to month it's slowing down. So no longer are we near the double-digit inflation. It's really come off, and that is that deflationary cycle. And I'm going to show you a chart which explains why that happens here in a moment, but I basically just wanted to show you what was going on. Now, I do want to take a look at the components of the CPI index, this time month over month, just to see what the changes were from last month, to see what is really propelling the fall in prices that we have right now. So we're going to put that up on the screen. And this is straight from the BLS.gov. This is total percent changes in CPI for all urban consumers, US city average, from seasonally adjusted from previous month. So unadjusted 12 months ended March 2023. Basically, everything was up other than energy for the most part. Energy was down a lot. We had double-digit deflation in energy, including gasoline and fuel oil. Energy services were up, including electricity and pipe gas. So what you're paying at the pump and what you're paying in your home for electricity actually went up, where the prices went down last month. We'll see if what you're paying at home actually goes down in response to lower energy prices, in the market. So these prices right here you're seeing are the industrial numbers, energy commodities, and then what you see at home are going to be these: electricity and unpaid gas and those types of things. That's what you pay, at the end. And that's still going up, even though the inputs into what you pay are actually going down a bit. So the inputs have to go down first before they go down to you. So we'll see next month if they go down to you. Also, used cars and trucks are plummeting. That's the other notable, down 11.2%. What's going up a lot is transportation services, up 13.9% year over year. Shelter up 8.2%. Electricity overall is still up at what you pay. Food items are up. Food at home and food away from home, that'd be restaurants and things like that, both up 8.4 and 8.8. So that's a big rise. So overall, the fall in prices was led by a couple of the energy commodities, but not everything else. Everything else is up. But because energy is such a big deal, it caused deflation in the overall index, and it caused the CPI then to come down. We're still, price gains from this time April last year, 5%, but it's less than the 6% last month and then the 7%. And so we're falling. And what does that look like? Well, before we look at this chart from a friend Tavi, who does a lot of research on this. We hit the big inflationary stage basically last year, and then we started to deflate. And this chart was done a month or so ago. I think we're actually here in the deflation cycle somewhere. And this will last for a while. It'll deflate for a while and come back up. Now, this is the 1970s inflation that led all the way to the beginning of 83, which led to the central bank raising interest rates to combat it. That's where that happened right there. But there were a couple of cycles before that, basically up and down, that we see here in Tavi's chart. And we're right here. So we're going to have some deflation here. And then I expect inflation to come back if that pattern from the 70s, 80s repeats. Now, this is a different time. It may not look exactly like this, but this is a fairly good guide of what we've got going on. Now, I also wanted to talk about labor. Labor has been weak. And here is continuing claims consistent with a recession. Continuing jobless claims. That means people that have been jobless for a while and they have filed more than once. Therefore, their claim is continuous. And generally, this will go up to a year. And then at some point, they roll off of the job indexes, the unemployment rolls. But essentially, what we're looking at here is the continuing claims. And the more claims we have, the more recessions we have. The recessions are in gray. So you can see as continuing claims spike, we're either in the recession or that's a result of the recession. And that's basically what happens. This was basically not a recession. This one here, it was a pandemic. You can barely see the line, but it really spiked during the pandemic because businesses had shut down. The economy shut down. So the claims went way up. And so that's what's happening now. We're starting to see a spike in claims, which is an indication that overall labor market is not that great. And it's hit the recession indicator. So if it continues to go up and spike up, that means, yes, we're in the recession. So another indicator of recession, just like the yield curve that we talked about before. I also wanted to talk about continued claims from the Fed chart. This is on a much longer timeline than what we saw on the other chart. And you can see here, you've seen that little ramp up here in this little section. You're seeing that continuous claims come up. Now, it's not where we were during the pandemic. It's not where we were during the Great Recession, the last financial crisis, or the tech crisis here. That's this one. But it is starting to turn up. And if it starts to go up this index, we're gonna watch it. That could be some issues going on in the economy. And that's something that we will pay attention to going forward. To give you a readout on the economy itself, we're going to head over to CNBC. Now, the markets are down a little bit. Dow has fallen 201 points today. S&P is down 16 points. NASDAQ down 67. Russell 2000 down 21. And that's as the earnings data and the economic data comes out, the things that we've been talking about, the continued jobless claims, the small business, the prices, the consumer price index, all of those things, inflation, all of those things are weighing on the economy a little bit. So the markets are just selling off a little bit today. It's digesting the news. No worries, though. We got more economic news coming out next week, and we'll talk about that too. This is a light sell-off in the stock market. I don't see anything big overall, just kind of a fade. kind of like we've had the fade in gold and silver. So at the end of the day, what I really think it is, yes, some of the economic data is negative, but people are taking profits. They're selling some things, or they're getting rid of things that they no longer want. And that's why everything's selling off a little bit today. It's just like a little breather stage in this economy where people can kind of get rid of assets and go to liquidity, because there's been a lot of move to liquidity. So you're going to see some sell-off in general markets for that. That's normal during what we see as an oncoming recession, by the way. And some of that sell-off in the markets is going to reflect the sentiment as people deal with the oncoming recession. So we'll continue to follow that. Bonds, aren't too far from where we thought they were. 2 years has risen again. It's back over 4%. That's not a good thing. When bond rates rise, it means bond buyers and investors are thinking that there's going to be more recession or more downward movement in the economy. The economy is going to get worse. And so the 2 years spiking up, the 10 years going up as well, but it's a 3.52. So people are actually paying more for the 2 than the 10. And that is a yield curve inversion. That means we have an oncoming recession. The second indicator, which I said we would talk about, looking at the cryptocurrencies, Bitcoin has been up for the week, but it's down today about 85 points at 32.97. Ethereum is actually up 65 points. It's going opposite Bitcoin today. It's trading at 2080.67. Litecoin is up 73 cents to 95.17. And Terra is break even. XRP is up a penny. And that'll do it for the cryptos. Those are doing pretty well. We're going to go look at the gold and silver trade for you, because I think that is a very interesting one as well. As we look at the CME group data, you can see here fairly light trading over on gold. Nobody's coming in and spiking it. But we're going to show in the COT report, we're in a previous period, people did spike that. And we'll relate that information to you. Looking at the volume numbers, June is the dominant contract month. I go over this every week, but we're going to shorten it just a bit. You guys get familiar with how to read this data, but I'll go over the highlights for you. June's the dominant month for gold. We're on the gold chart. 414,000 contracts on open interest as of, this is Thursday's data, so yesterday's data. We don't have today's yet. 6,181 contracts added. So this is a very robust month. June is the one that's trading. That's what's determining the prices. Total volume is good. EFP, which is exchange for physical, move over to London for exposure, is high at 4,043. That's because April is not expected to be a big delivery month. Why is April not a big physical metal deliveries month on the COMEX? Because there's not that many contracts, and you have to have a contract to get delivery. And so there's not a lot of contracts. So there are some deliveries, you got 91, but a lot of those deliveries are going through the COMEX and a future trade month where you can't take delivery on COMEX today. And they're going over to London to get exposure there and potential delivery and how that works. So those are pretty high. If we look at the settlement data, this is just what determines prices. Again, down on the day. Now, this is Friday's data. They do have preliminary Friday data here. You can see right here. So we're down about $40 on the day, according to this contract data. It's not completely updated. Again, June's the dominant month, and you can see that trade action right there. We're going to do it on silvers too. So, and this is a holiday, by the way, where you're seeing this gap. But silver actually spiked up quite a bit, and we'll explain why that in a moment when we look at the COT report and get a good indication. Right now, May is a dominant month for silver. It's actually moving over July. You can see that 1,900 contracts coming off here, 8,000 coming on here. So the positioning is actually into July. And that's part of the reason that some of the contracts are moving around. And you see it in the COT data is people are moving to the next dominant contract month. They just roll that contract over. And so you close some here, you add some here, and that's the way that that goes. Plus, it looks like we have a lot of new interest because it's such a high number. But as of right now, May is still the dominant contract month, slightly over July. We had 79,904 contracts. This is Thursday's data here. So 79,904. Again, not a lot of deliveries because on the current month, you only have 25 contracts of silver open. Remember, on the industrial markets in the U.S., on COMEX, which is CME and NYMEX and all those, which is CME Group manages, you only about 6 months are considered higher delivery months on COMEX for physical deliveries. So they'd be high trade months because of the trade. And the other 6 months are lower. They'll have less action. So that's why you see big numbers in some months and lower numbers in other. And so when you're looking at physical delivery, it typically has to come during a month that has a lot of contracts to begin with, or otherwise you're going to have modest numbers. And that's how that works. So 1,466 contracts in Thursday's data went over to London because there's not a lot for the April contract. And that just means people are trying to get exposure to the physical in the current month. They just can't do it on COMEX because the current month's not the one that has contracts. It's May and it is July. Moving over to the settlement data. You can see here, this is today's data, preliminary data for Friday, and that's up to date as about 1:32, so it's not too old, about 15 minutes old, according to what CME Group's telling us. The dominant contract month for silver right now is May, but you see July kind of sneaking up there. But you can see the prices here, down 47 cents, sell at 25.46. And then we look at the commitment traders report. We're going to do this one really quickly. We're going to come down to silver. There's been, some sizable moves in silver, of course. The producer merchants are going a little bit more short to protect their prices in the future, which makes sense. The swap dealers add some short contracts. The managed money goes long, and the other reportables basically the same. They're almost even there, a little bit net short. And these are the wealthy individuals and financial houses. These are the big financial houses and big financial traders. These are the bullion banks, and these are the ones that produce it and use it. The Apples of the world, the Samsungs, and also the miners. So not a lot going on in silver. It looks like a little bit more short on the bullion bank side, a little bit more long on the managed money side, and then the other reportals is about the same. So we go down to gold. There's a big difference in what's going on in gold. This is gold as of April 4, 2023 from the CFTC, the regulator. And the big number I want you to look at is right here. So the swap dealers of the bullion banks have launched their bazooka. 10% of their total short interest was initiated for the data leading up to April 4th. So the week prior to April 4th, because it's April 4th date and it's done in arrears. So prior to April 4th, that week leading up, the swap dealers of the bullion banks just launched a bazooka of short positions at gold, a bazooka of short positions at gold. And what that does is it causes the gold price to fade. Because remember, the spot price on the market is not determined by what, the money you hand your local coin dealer, the physical trade, or even what you may pay, one of these online bullion dealers. It's the contracts, it's the paper market, most of which is not physically delivered. Most of it is just speculative positioning, kind of like a stock or a bond or something. It's a piece of paper. And what happens is you can do a bunch of futures contracts at once with a little bit of money. It's a leveraged investment, so you don't have to put in the full value of the contract. You may have to have some other things, but in any case, so you do that, and they use a lot of contracts to control that gold without having to buy it or sell it. And so that's put downward pressure. Now that's been offset by the long position, the managed money. So the managed money or the financial houses and brokerages are going long to the tune of 11,000 contracts. The other reportables went long a net of about 2,700 contracts, long 92, short 65. So that's what's going on with gold. So it appears to me as if people are going short gold, a little bit short silver, but really short gold. Why? Because gold and silver spiked so much. Gold approached its all-time high. As it started getting close to its all-time high around 2000 and higher last week, that caught data, the bullion banks come in and just, hammered it and shorted it. And I think they were anticipating the price coming down, or maybe they're trying to, to move the price down. If you put enough contracts in, you can actually move the price over time because it's the longs and shorts together which determine the price. So to summarize, deflation has struck the economy. It's not long-term deflation. We're not out of the woods on inflation yet. It is a stage, and it is the first step in what looks like maybe a three-step stair-stepping process up to the final ultimate resolution of inflation in the economy. We've had mixed results in terms of the economic data. It looks like consumer prices are coming down. It looks like continuing jobless claims are going up. Small businesses are losing a little bit of confidence. Business inventories are increasing, which is causing slack in ordering overseas. So we saw the overseas prices coming down and current prices coming down. And that's basically, the news for the week on the economy. Stay tuned to next week. We'll do the weekly market wrap up. Again, I'm your host, Rob Kientz with Gold Silver Pro.